Good afternoon, everyone, and happy NCAA tournament day for those of you that are into basketball. I'm not, but I certainly am this time of the year. My name is David Scherer. I am co-CEO and co-founder of Origin Investments. Specifically at Origin, I'm tasked with leading the acquisition and investment management teams. One of the team leaders of which is on the call with me today, David Welk. I'll introduce him formally in a moment, but we're very lucky to have him. He can dive very deep into the deal pipeline and talk about all the different activities we have for this fund. Importantly, we've been working on sourcing this fund for over 18 months, and I'll get back to why that's so important. And Dave will stress that as well in terms of the value that we've been able to build. The format is going to be, I'm going to give a brief introduction of Origin. It's very important when you're making a decision on investing in a fund. Is think about it this way: you're investing in a company. The fund is a company. That company is run by a management team, and the management team itself needs to have proven that they know how to create, protect, and build value. So I'll spend a little bit of time on that. You also want to know that the management team has been together for a long time, executing similar strategies. So I'll start there, and then I'll talk a little bit about the fund, the benefits of the fund, the structure of the fund. And then I'm going to turn it over to Dave Welk, who's going to cover our deal pipeline and go a little bit deeper into 4 or 5 specific deals. He's going to take you on a little tour of Google Maps so that you can experience the area and why we like it. And then I will cover fund terms. And what I want to do is leave about 25 minutes of the hour for Q&A, which if you've been on our webinars before, please use the Q&A box at the bottom. We encourage live Q&A. You can be anonymous, you can not be anonymous. We're committed to transparency at Origin, so we really do want to answer every question that you have. So with that, I'm going to jump right in. A little bit about Origin, and I apologize, there's a lot of people on this webinar, and I would say I think there's 400 people, and of that, probably 25-30% are existing clients. So if you're an existing client, I'll be very brief, but there are a lot of new folks that don't know Origin yet. So I'd like to introduce the firm to them. On the left, we talk about Origin being a top decile manager. There's a footnote. I don't often read footnotes when I'm reading, but I think it's really important because the footnote says we're actually not top decile. We're number 6 out of 181. That puts us in the top 3% of global real estate managers. And then most importantly, this is what our team is most proud of. That's not for a fund, it's for all the work we've done since 2014. And so that's just an enormous data set that actually straddles 5 different funds: Fund 2, Fund 3, Income Plus, QOZ. There's just an awful lot of data that goes into that. And we're proud of the consistency of our returns, making us top 3% globally. Our focus at Origin is we do one thing, multifamily. That's all we do. Some of the questions that we received, thank you, by the way, we had, I think, about 4 dozen questions prior. Some of the questions were about other asset classes. We don't do anything except multi. So if you are interested in hotel investing or industrial investing or retail investing, you would not partner with Origin. If you're interested in multifamily investment, that's all we do. We have 40 people at Origin who wake up in the morning and think about multifamily, how to buy it with an edge to the market, on market, off market, how to build value, grow earnings, manage risk, and sell it at attractive pricing. How do we become a top decile manager? Some of the numbers on the right sort of affirm it. The 24% average gross IRR, that's across all of our realized deals. At this point, that's 14 years of data, so there's a lot of data in that. The 1.4 billion of assets under management, that doesn't include all of our development pipeline. So if we were to have this webinar in 6 to 12 months, that would be more like 2 to 2.5 billion. The 65 million of personal capital by principals, that's myself and my partner, Michael Episcope. Michael and I, over the life of the firm, if you will, we have this is our 8th fund. So, we'll be co-investing $5 million in this fund, but we also co-invested in Fund 1, Fund 2, Fund 3. We think it's really important to be aligned with our investors and to share your goals. And we take that very seriously. Dave Welk and other senior leaders, Dave Welk's a partner at the firm now as well. He co-invests as well, but he's a little bit newer to that game. Michael and I have been doing it since day one. And in fact, this firm was founded to invest Michael and my capital. That's the sort of origin, if you will. We have 2,600 active investment partners, and those are investors in one of our funds. This is our development fund. So, these are funds that you're really targeting very high IRRs. We have other funds that are dividend funds, or we have funds that are a combination of dividends and growth, like our Income Plus. So we have lots of different funds that all within multifamily, but they all target a different investor goal, if you will. And this is sort of our version of venture capital. If you're interested in outsized returns and growth, that's the fund that you want to be in. This one, Growth Fund 4. 50, actually it's 52 now. We have 52 investment advisory partners. So if you're an investment advisor, we have 52 firms that have approved Origin as a platform and invest into Origin funds on behalf of their own clients. And so that's a very fast growing part of our company as well. Next slide, please. So let's talk about Growth Fund 4. Growth Fund 4, as I said, is our highest expected value, highest return growth fund. It really takes advantage of our development expertise that we started in Fund 2. This will actually be the 5th fund that we invest development into, multifamily development. Fund 2 was the first. Fund 3 also has quite a few development deals in it. And then, of course, QOZ 1 and our Income Plus also has development, quite a bit actually in that fund. So we'll get to our experience in a moment, but I'm giving you a little flavor of just how experienced we are. This will be the 5th fund with development in it. It is our first, however, exclusive development fund for market rate capital. And what I mean by market rate capital is our QOZ Fund 1 and 2, you have to have capital gains to invest in order to get the tax benefits. So the interesting thing about Growth Fund 4 is for clients or potential partners who don't have capital gains, or not sizable capital gains, but they do have capital that they want to invest, they would invest into Growth Fund 4. And so that's your opportunity to do that. So why would the key benefits here, opportunistic returns. When we say a 14 to a 16 net IR, that's after fees, after promote, that's what you get. And obviously that's a range, that's a target range. I will tell you later on a slide that's coming up, our actual returns in IRR have been much, much higher than 14 to 16 net. We tend to want to underpromise and then over-deliver, and we'll get to that, but we've traditionally done much, much better than this. However, the 14 to 16 is a very good return on a net basis to you. And then the average hold here is more like 4 to 4.5 years, and that's what equates to your 1.7 to 1.8 net equity multiple. And the way to think about that, if you're new to the concept of an equity multiple, it just means if you invest $1 million into the fund, 4.5 years later, you should be getting back 1.7 to 1.8 million dollars, and that's the concept of equity multiple. Candidly, we're much more focused on equity multiple than IRR, because equity multiple is really what creates wealth. You can spend equity multiple IRR is more of a derivative math concept. It's not spendable, and it's a function of time as well as returns. Diversification, this is really important. When you invest in a fund, you're getting, any fund, but in an Origins fund, you're going to be getting, 10 to 15 developments across all of our target markets, and I'll go over that in a moment where that is. So you're getting diversification geographically. You're also getting diversification from a vintage standpoint. In other words, we're not investing in all the deals at the same time. And so, different variables move in the market. And so you're getting that diversification over the investable period. And then the last thing is a feature that I think is pretty unique to this fund, and that's the optional hold period. So if you're an investor that wants to get out after 4.5 years, you can, and you'll get the return that I'm suggesting here. If you want to stay in, you can also, it's an option, not an obligation, but if you choose to, you can stay in. And there's a lot of really interesting tax considerations for doing that, as well as you can build much, much more wealth over time than being in an investment 4.5 years, paying taxes, and then reinvesting it post-tax. I would tell you that's a mistake that Michael and I made early on with Fund 2 and Fund 3. We generated a lot of wealth, but then everyone paid taxes, and most of our investors who invested in Fund 1 invested in Fund 2, but they were investing after-tax dollars. And so all these things are considerations that you learn and grow from. Interestingly enough, all of our clients, I mentioned earlier, we have 2,600 clients. We share one thing. Every single one of us is taxed. We don't have any non-tax clients. We don't want any non-tax clients. And the reason is our funds are structured for tax efficiency, and we all have the same goals because we're taxed investors. A non-tax client would not want to go into any fund we have, candidly, because they wouldn't be getting the benefit. They don't pay taxes anyway. But the option of staying in is really powerful, because what's happening is you've generated lots of profits, and you're in a very, very protected position. In other words, we're building units for $250,000 a unit. They're worth $350,000 a unit when you're done. So you're very protected. You've generated profits. If you choose not to take those profits, you can then move into a world where you can depreciate the asset. You get lots of cash flow, and you can continue to grow your profits tax-free. And so that's what I'm interested in as a tax investor. But you as an investor can make that decision. It's an option. You can either get out or stay in. If you choose to stay in, the target net annual distributions are 4.5% to 6%. What's interesting about that is the depreciation offsets the distribution. I wouldn't expect that you pay any taxes at all in that period. The target net annual appreciation, that's just generally asset level inflation. So that doesn't even account for what I believe is our ability to grow earnings at an above market rate, which we have been able to do. And that gets to your 8 to 11% return. But importantly, this is the optional period. That 8 to 11% return happens with no taxes. And so that's what's really interesting about real estate is we can't appreciate it while we're building it. It's not built. But once it's built and occupied, you can. And that's why it's such an interesting longer term hold. The graph on the right shows you a hypothetical investment of $250,000 and what's happening in year 4. And if you look right around the $450,000 area, that's where your option is going to be happening. So you can take the $450,000, or you can stay in, but you can see what happens year 5, year 6, year 7, or 8. The power of compounding is remarkable, and the most successful investors aren't ones that get in and out, in and out, in and out. Next slide, please. We've had a tremendous amount of questions. Again, this is our 8th fund. So one of the things we do at Origin is we're really completely committed to transparency. And One of the things that we do is we have quarterly investor updates in webinar form. You'll also get written updates, but in addition to the written report, we do webinars, we answer Q&As for each of our funds. And the reason I'm bringing this up is we get so many questions about the same things, and it's helpful. And so I can tell you, because I'm also on the QOZ1 and QOZ2 and Income Plus webinars, that people are very concerned about inflation and they're very concerned about interest rates going up. And of course, those things are linked. And I would just tell you, we share your concern. And the reason that we're hedging our interest rate risk, the reason we're doing it, it's very simple. Development right now is an unbelievable investment opportunity. In fact, even though we've done developments in 5 other funds, we've never seen the development margin as high as it is right now. This is the highest margins I've seen in my career, and I've been doing this quite a while. And the reason is rent growth and cap rate compression are more powerful forces than construction costs going up. And so the margins are actually higher than they've ever been. The other reason is there's just an awful lot of money looking to buy hard assets, whether it's pensions, endowments, sovereign wealth funds, private equity. And there's been a wealth transfer from those core buyers who are paying much, much higher pricing than they ever have to the developer. And that's why we're so focused in this space right now. The reason I want to hedge interest rates, and I can get into some of the strategies why and how we do it, is because I want to protect that margin. The margin's very high. I don't want to lose margin because interest rates went much, much higher and eroded the margin. And so at the margins we have right now, it makes all the sense in the world. So just to give you an example, in the last, about 2 months ago, we hedged about 300 million of debt. And then about 6 weeks ago, we did another 380 million of debt. And that was done through swaptions. And it's not just for this fund, it's for QOZ, it's for Income Plus. We are a company that hedges our interest rate risk. When you're building construction, 95% of the debt available is variable rate debt, priced over LIBOR, right? And so what you need to do is swap that debt for fixed rate debt. And you can do it through swaps. That's a contract generally with your lender, but they have to have a swap desk in order to do that. Or you can do it through option strategies. They're called swaptions, but it's essentially you're buying an option to lock a rate at a future date with an expiration. You can also do it through long-term HUD debt. You can do it through Freddie Mac and others. Those are fixed debt options, but those are typically available once built. So swaps and swaptions are what we're using during the construction period. HUD and Freddie Mac is what we're using as we move from the variable to fixed rate product or loan. We'll be doing entire webinars on just this. I would say that we're experts at this point. And it's something to ask any manager in this environment is, don't tell me what you plan to do or your policies. Show me what you've done, how you do it, because it reflects a lot about the risk management of a firm, and it makes sense to tactically make them get in the weeds a little bit. Next slide, please. I mentioned this before. This is our actual development experience, and we're talking about 14 to 16% net returns, but our historical realized return has been 33.7. Now that's on a gross basis, so it's not apples to apples, but generally you're taking about 20% to get to gross to net. So, let's say it's 25% on a net basis. I'm not suggesting we're going to get 25% in this fund. I am suggesting that we will outperform the market. Whatever the market is and provides, we will do better than our competition. That's why we're a top 3% manager. I'm confident in that. And then you see not only the scope, but you also see, it's not just 1.6 billion of asset costs and 468 million, but it's also all of the markets that we're still in. We have the same management team, the same people, and the same markets doing the same thing. So go back to the last slide, please, for a second. You'll see Atlanta, you'll see Dallas, Denver, Houston, Jacksonville, Nashville, Orlando, Phoenix, Raleigh. Those are all the cities that Dave will be going over in our actual deal pipeline. Importantly, this fund, and Dave will drive this point home, this fund is largely already sourced. You don't have to wonder what the deal is or where you'll be invested or any of these things. We've been working on this for over a year and a half. We have the deals that will be in this fund. Next slide. This is where we invest. So, we talk about it as the smile. Starts in the Southeast, obviously Texas, and then you're talking about Denver, Las Vegas, Phoenix, Tucson, Salt Lake City. We also do a lot of development in Colorado Springs. We group the Denver, Boulder, Colorado Springs market as one very large submarket. On a good day, you can get to Colorado Springs in 45 minutes from South Denver. And so why are we here? I'll get to our machine learning and AI in a moment, but the why we're here is 10 years ago, we ran our own algorithms, if you will, and decided it makes the most sense to follow where people are moving, population flows. We wanted to be in low-cost states. We wanted to be in lifestyle cities. We wanted to be in warm states. We wanted to be in business-friendly states. We wanted to be in low-tax states. And that's exactly where we wound up. Nashville is another. But if you think about, just to pick three, Florida, Texas, and Nashville, these are all, top 5 states and cities where people are moving. One of the reasons they move there is there's no income tax at the state level, 0. So, I'm sitting in Chicago. I think our rate is 5.5%, 6%, but property taxes here are probably higher too than they are in Nashville and Florida. So it adds up, and people make rational decisions. And so what we've seen in the last 10 years is an acceleration of movement from the Northeast, California, and the Rust Belt into these states. And our belief is that we're still in the early innings of this. But a lot of our performance over the last 10 years has been that we've been right on location. And importantly, in this fund, we're leveraging 10 years of experience in these cities and states. We have offices in Nashville. We have an office in Dallas where people live and work. We have an office in Charlotte. That's where Dave will be doing his part of the presentation from. We have an office in Denver. And so these long-term decisions about where you put your talented people to work and live and source and build relationships and build deal flow and connectivity to the community, these are long-term decisions that this fund gets to leverage. So you have to ask yourself a few decisions. One is, do you want to be in multifamily as an investment? But also, are these the states that you think are going to provide, the economic benefit to you and others who choose? Or would you rather be in a coastal strategy or a Midwest, sort of counter-cyclical strategy where, you think that people are going to move back there over time? These are things you should think about. We believe we're in the right states. About 2 years ago, we decided that all of the analytics that you can license in the market are inferior to what we need. And most of the licensed products you buy, what they're really doing is they're rent prediction models, because future rents in a year, 2 years, 3 years, 4 years are a really important part of figuring out asset valuation today, right? Does it make sense as an investment? And what we found over really 8-10 years is nothing that we can license was good. Nothing that we could license allowed you to backtest their results. And nothing we could license went granular enough. It always stopped at the zip code level, but zip codes are really large geographic areas. We really want to get down to the building itself. And so we spent an awful lot of time and hired 2 data scientists to build our own. And that's what Origin Multilytics is. It's a city selection model. That's the atemporal, the non-time sensitive model. But the temporal model is a rent predictive model, both where rents will be today and in the future. It takes in 2.7 billion pieces of data monthly. And the key is not just the organization of data, it's also understanding what the most important variables are, because too many variables can actually muddy a model. It can muddy results. And the notion that more variables is better, that's actually not true. You have to run constant regressions to understand what's important and then overweight those. What we've found over the last year, but really the nice part about our model is we can back test it for 5 years. But just for example, last year, our rent predictive model was anywhere from 5 to 7 times more predictive than the market leader in every market. And we'll do another webinar just on Multilytics. We can easily spend an hour. We won't really get into the why because the why is proprietary. We have patents pending. So we won't spend a lot of time on the why, but we will show you the results. And we believe it's really powerful that we have a non-biased city selection and rent growth model, but we pair it doesn't make decisions for us. We pair it with the local knowledge. We live in our markets. Feel still matters and relationships matter, right? But it is a really important tool. And importantly, it corroborated we're in the right cities. So that was good. But it does a whole lot more than that. And we'll be leveraging this for this fund, but also all of the funds that we have. Next slide. I believe that's it for me, Dave. So you're going to take over, and then I will come back and talk about the terms, and then we'll do Q&A.
Sounds great. Thank you, Dave. And good afternoon to you all. Great to be with you. As Dave mentioned, I'm going to run through this deal pipeline slide here, but we're also going to attempt to take a little tour on Google Earth, looking at some of these initial seed assets for the fund. We're going to start not quite in this order. We're going to probably start from the west and starting in Phoenix and then traveling east, hitting a couple deals that we have here in the pipeline in Texas. And then we'll run over to Nashville quickly, talk about the Haven and Cool Springs opportunity. And then we're going to end here in Charlotte, where Dave mentioned I'm sitting at today on the most recent deal that we just tied up, which actually was as of Monday of this week, a deal that obviously I'm personally excited about, but frankly, very excited about this entire pipeline of opportunities that we've built. And I did try this Google Earth presentation when I was traveling in Nashville for a prior webinar, and the internet went down mid-presentation, and it wasn't pretty. So hoping today that we paid our internet bills and I don't get disconnected. But I do want to give a couple of just general pipeline notes that, and sorry, just to go back to the prior slide, is where we've spent some time over the last 12 to 15 months really building this pipeline prior to the launch of this fund. And why is this important? It's important because land pricing in all of our target markets over the past 12 months has effectively doubled. And really a lot of this appreciation, perfect, thank you, has occurred in the past 4 to 6 months. And so our land bases that we have under control for this seed assets on the slide here represents land bases that are significantly in the money, and it depends on the market and the respective basis. But generally speaking, we're talking about $15,000 to $30,000 a door of increases from when we put these land sites under contract. So picking the midpoint of that, roughly say $20,000 a door, average deal size of 250 units, we're talking about $5 million of edge per deal. Multiply that times 6, we're talking 30 million of collective fund equity land basis edge that we have to the deal. So that is real, and it's right now we're very excited that the pipeline is as large as it is. As Dave mentioned, we've done a lot of the sourcing already. We're still seeing a lot of opportunities coming in behind these, which we'll talk about towards the end. We have $1.4 billion pipeline totaling about 5,000 units of activity behind this. The attrition rate of our pipeline has been getting higher. Certainly it's been growing as costs continue to escalate, and the more capital is chasing the multifamily in the space than ever before. But the fact remains that the pipeline is large, and even a small percentage of that will certainly fill up the remainder of the equity in this fund and put us in a great spot. So the other thing to mention about the pipeline here is that the majority of these deals, as you can see, are structured in this co-GP LP format. And for those of you who aren't familiar with that is, effectively what we've done is we've created these programmatic ventures specifically with a group called Geffen, who I'll talk about here in a second. Very valuable partner to us, been highly prolific across the country, as evidenced by a significant number of these opportunities are partnerships with Geffen. But what that means is that we share in the economics of the developer. So what that effectively does is it offsets any dilution that we might have in a traditional JV economic structure, so that we're able to produce and deliver the deal level return to you all as investors. So what that will do, we believe strongly, is continue our consistency of performance that we've recognized over the last 8 funds, as Dave has mentioned, and continue to place us really, within that top decile or better range. All right, so Preserve is a very exciting opportunity for us. This actually represents our first build for rent deal as a firm. And for those who are not familiar with what build for rent is effectively rental townhome product, or in cases and in this particular case, it's more like individual single family rental product. This product itself is in high demand, certainly for capital because of the higher yields it produces, but it's also in high demand because of the renter profile who wants to live in this type of product. And the typical resident, and I'm sorry, this project here itself is located in Austin. So it's in a very affluent suburb of Austin called Pflugerville. And the interesting part about the location here is that typically in highly affluent areas, you can't make the land pricing work in terms of building lower density product. Land values are generally going to be higher in these affluent locations. You're going to need to build the product that's more typical, that looks like the rest of our portfolio here. So it'll be a 4 or 5 story project, either garden or structured part. This is a testament to our partner Geffen here, who was able to get a very attractive land basis. They assembled this parcel over several months. A lot of these land parcels that they assembled were owned by single family homeowners. So it wasn't like this was a commercial parcel here that they put together. So they assembled nearly 30 acres of land for us to build 310 units of a effectively single family residential. So very low density. We're talking roughly 10 units per acre, which is a very typical yield for a build for rent project. As Dave mentioned, our AI tool that we developed has rent growth here that's frankly off the charts because of the high barriers to entry in this location, because of the demographics and affluency. You have some of the best schools in the suburban Austin market that we have access to here. Average incomes here of $110,000. So again, this is what's really going to drive the desirability from a resident point. We're very excited to get this project underway. This is not our partner Geffen's first build for rent deal. They launched one last year in Kingwood, suburban Houston. So they certainly have learned some things from that project that are being incorporated into this one. Again, couldn't be more excited. Back to the story that we talked about before of having this land basis under control for a long period of time. This is exhibit A of that. This is March of 2021 is when they put this land under contract. So we've acquired this site already, closed on it, and we expect to be breaking ground shortly. So we will be off to the races here probably in the next 30 to 45 days. Next site here is Haven at Apache. I was just actually in Phoenix, flew back last night. This is a project located in the Tempe submarket of Phoenix. So for those of you who are familiar with where Arizona State's located, we're about 1.5 miles away from ASU's main campus. And what's interesting to note here, and again, this is another opportunity in partnership with Geffen, where they've controlled the land site for a number of months. This is located on a light rail station. So we're about 100 yards from the front door of the platform. So this is going to be a TOD project. This is a little bit smaller in terms of the total unit count here. It's a rather tight infill site, so it'll be about 182 units. And this is going to be built in a wrap style construction method or design, which just means the parking deck, which is 5 stories, is wrapped by the apartment units. So locationally, really, really high profile and high quality site. We mentioned the proximity to Arizona State. Tempe as a submarket has become one of the most desirable places to live in Metro Phoenix. A lot of that has to do with the ASU and their partnership with a number of large companies that have chosen to locate in the market. So for example, State Farm built a large campus that is also about 1.5 miles, 2 miles from the site located in Tempe Town Lake. So massive job provider there of all different levels of incomes across the executive level to some of the more back office folks that work in that campus. But I think in total build out, that's about 5,000 jobs in total. The Amazon has also moved into the submarket in a meaningful way in one of their software development arms. So we have a really large cross section of employment just in Tempe alone. But then you can hop on the light rail, which again, out the front door, you're about 12 miles from central Phoenix on the light rail station. So you can get to the job centers that are located downtown, and then you can also head out towards downtown Mesa and hit up some of those employment opportunities as well. So we believe this is going to be very attractive product to the young renter, which is the 25 to 35-year-old demographic. Given the amenities that are located in Tempe, given the proximity to the light rail. So we just closed on this land site last week, and similar timeline, we expect to be breaking ground in the next, roughly 90 to 120 days. But the site's fully zoned, entitled, and then we've finished up our designs on the project itself. We're just wrapping up our negotiations with our general contractor. The next site here is going to be Solis at the Ranch. And as Dave mentioned, this is located in Colorado Springs. We've been one of the most active developers. In fact, I believe most active developer in the greater Colorado Springs area. That has been with our Qualified Opportunity Zone Fund. We're certainly the most active developer in downtown Colorado Springs. This project itself located more out in the suburban location within Colorado Springs. And this is one of a couple opportunities that we're partnering with a developer by the name of Jackson Dearborn, who has been themselves a pretty prolific developer. I believe this marks their 3rd or 4th project that they've started in Colorado Springs. For Origin itself, as I mentioned, this is our 4th in the Springs market. Tom Briney, who heads up our Denver office, has been exceptionally prolific in this market. And this is a market that has performed exceptionally well in our AI modeling. Tom saw, it gets back to what Dave mentioned before. Tom had the vision, from a guttural standpoint, spent a lot of time in the submarket, knew this was a great play relative to traditional conventional Denver, 45 minutes from the southern suburban rings of Denver, but still has all the mountain lifestyle that folks are looking for in this part of the country. And they also have a very vibrant downtown as well. So we're very excited about continuing to build our footprint here. This is going to be a 374 unit garden style project. So all surface park. That's part of a larger concept plan, which we will not be participating in, but certainly benefits the locational attributes of some additional retail and entertainment that's coming in right next door. Again, back to being a high demo location. That's another thing that we love about this specific site. It's not as infill maybe as certainly our downtown Colorado Springs locations, but the average household incomes up here are north of 100,000, and immediate single family homes that are up here are between 400,000 on the low end and up to $1.5 million on the high end. So again, highly desirable location from a single family standpoint. And we've seen that those locations are obviously also in demand from the renter pool as well, like to be co-located with higher end single family residential. Locationally up here, residents are going to have access to a number of job drivers. St. Francis Hospital is one of the primary demand drivers in this location. So really good access to healthcare jobs. That's about 1 mile west of the site. So we will be land closing scheduled for this project on April 1st. So about 2 weeks away. And we anticipate to be breaking ground here roughly in July of 22. We'll move now to Haven at Cool Springs in Nashville. This is again one of the projects that we are underway with in our Geffen partnership. This is a larger deal in total, just given the nature of the product. This is 5-story product over 3 levels of podium. So structured park podium deals are generally a little bit more expensive to build, just given the nature of the complexities of the design, the cost of the garage, than your conventional 3-story walk-up surface park project. So this will be about $90 million in total project size. Thing we're excited about on this project and location, it's within Williamson County, which is, again, back to the theme here is high demographics and barriers to entry, and this location in Franklin certainly fits that bill. There's really high impact fees in Franklin. There's very few land sites, despite the fact that it's actually suburban in nature. And the other thing that makes it challenging to build here is Franklin has very restrictive zoning within the city itself and then the county as well. So we are, again, this was a gem that was found by Geffen, off-market transaction. We closed on this land site for the fund last month and looking to go vertical really in the next 60 to 90 days. But we've been tracking rents here since this land site was put under contract, and this has been no exception. We've seen continued double-digit rent growth, over the last certainly 6 to 9 months, but over the last, really, if you go back 12 to 18 months, you've seen almost 20% rent growth in the submarket. So we're excited to get going on this one, and this will be a near-term start.
Hey, Dave, I'm gonna take over just because there's only 15 minutes left.
Yep.
You get the flavor. Dave can do this for hours and hours and hours. So if you have questions, we can go deeper into any particular deal, and then we just don't have time to do it. I will say though, Dave, since you mentioned Geffen a few times, we have 6 or 7 partners that we've done tremendous amounts of business with. Geffen is one, Greystar is another. I could go on, but these are partners that we really value, and they bring deep expertise, not just the deal pipeline, but Geffen, for example, integrated GC and development. They're in a Fund 3 deal with us. For the Fund 3 investors who are on the phone, this is a deal we did 5 years ago, but it gives you an idea of what I was saying earlier. This fund is benefiting from 10 years of work. Yes, 1.5 years for the deals you see, but 10 years of work of relationship building and finding the folks that we want to work with and don't. the deal we did with Geffen in Houston was a mid-30s IRR deal. They performed on time, they performed on budget. Um, this is not an entity that we haven't fully vetted, and Guillermo and Richard and others on their team they're very talented, but they're also very honest, the type of people that you want to do business with. That's the theme of everything we do here. We don't, figure out who a good partner is or what a good deal is. This is all building on the shoulders of other things. I'm going to move on, Dave, and I really apologize that you're a victim of your own depth of knowledge. You can go on forever, but we don't have forever, right?
All good.
But that's why you lead the acquisition team, and that's why Dave's been with us 11 years, to give you an idea. So he was prolific in Fund 1, Fund 2, Fund 3. He's a great example of the type of expertise that you're getting, and those returns were produced from the deals Dave individually or his team sourced. But I could say the same thing about investment management or general counsel or accounting. It goes on and on. These people have all been here the whole time. Okay, so I'm going to start actually with live questions. For those who sent in the questions prior, we covered them in the presentation, with maybe one exception. We get a lot of questions about 1031ing. Can I 1031 money into the fund? And the answer is no. We're not a fund that you can 1031 money into. There are funds set up, they're called DST funds, where you can do that. We don't have funds like that or deals like that. I would be careful. Those are niche funds. And like I said, the first thing I said, if you remember, the first thing you have to do is vet the manager. Don't fall in love with a fund that you can 1031 to, or a deal, or any of these things. Like, that's a feature. That's not a management team. So spend all of your time vetting who you are doing business with. Funds are better than individual investments. They're not different, they're better, and I'll tell you why. We cross-collateralize all our promotes. So all the fees that you're paying us, the incentive fees, they're only paid if all the deals work. And if you do a bunch of individual deals, they're all non-cross collateralized. So certain deals will work and you'll pay fees, and a certain won't work, but you don't get the fees you paid back. So there's certain things that are different, and there's others that are just worse. It's worse to be in non-cross collateralized investments. The flip side is, when you talk about debt at a fund level, one question to ask a manager always is, do you cross collateralize your debt? And if the answer is yes, don't invest in the fund. We never have done it. We never would, because it exposes us and our investors to risk that's unnecessary. So if a manager is cross collateralizing debt, it's a good indication they don't understand risk. So that's a very easy question to ask any manager. Another is, how much debt do you use? And generally in real estate, if you're using above 65%, just don't invest there. There's no reason for that. We generate our margin and our return based on expertise, not high leverage. All right, I'm going to jump to questions, and Dave, you can answer the first one. Andy, thank you for your question. We're going to go a little bit over, maybe 5 minutes, so we can answer all these. Dave, how do you see rising interest rates affecting the fund's strategy and rising costs? So he said both, but you can handle that.
Yeah, on rates, Dave touched on this earlier in the presentation about some of the things that we're implementing to address rising rates, which is, we have a variety of tools at our disposal that we're actively implementing. I'll just touch on, one or two of them, but certainly swaps themselves, or putting fixed rate debt is a way to get ahead of that. Now, on the fixed rate debt component is more challenging to execute during the development stage, and that's why swaptions are becoming a very important part of our strategy. So swaptions allow you to actually hedge interest rate risk without having an underlying collateral you can fix the debt to. So it's more expensive, but it's a very interesting insurance policy that we're purchasing for all of our funds. So that's one way that we can implement that across the board. I would say that rising rates in general isn't necessarily affecting our strategy. Our strategy here is a development fund. So we're looking for the best risk-adjusted development deals in our markets with the highest expected value. So I would say that as its overall fund strategy, that would, it's not necessarily being effective. What it's affecting is our tactics and how we mitigate that risk. On costs, similarly, we're looking to mitigate costs whenever we can. We are in a very unprecedented cost environment. We've never seen this before in terms of supply chain disruption, in terms of just material cost increases month over month. But we're taking frankly as proactive measures as any investment manager that I know of in terms of securing individual line items early. So we're buying out our lumber packages and truss packages to the extent that we can. We're leaning on our partners that are vertically integrated that'll take on as much of that cost increase risk through a GMP as we possibly can. A GMP, a guaranteed maximum price contract from a general contractor has gotten to be very difficult to find, but we've been able to get a number of those put in place for our projects where others in the market cannot. So, and the last thing on that front is, again, locations that have highest expected growth, the growth will bail you out in terms of cost increases. And we've seen this in all of our markets where rent growth in any given market, and a lot of, on the high end, Tampa has been in plus or minus 30%, but most of our markets have been around the 20-25% year-over-year rent growth, which has more than absorbed a lot of the cost increases that we've seen. Will that continue? Time will tell, but we will find the best locations that will produce the highest expected value.
Yeah, thanks, Dave. I would just add a couple things. One, the margin's never been bigger. And so if you wind up having slight cost overruns, it doesn't matter. We used to like to do deals with a 30% margin. Now they're 40 to 45. So you can absorb higher costs and still have lots of profit. That's the first thing. The second thing is when we're underwriting, we're underwriting 2%, 1.5%, 2% increases in costs per month, literally. And so like we think we're going to build 6 months out, we're pricing in 6-8% cost increases between now and then. And that's candidly, that's just unprecedented. We've been doing this for a decade and no one did that a year ago, right? So there's plenty of fluff in our budgets, extra contingencies, lumber allowances that are far above, where we could buy them today. That's already in the model. And then beyond that, you've got a tremendous amount of margin on top of that protects you. All right, so next question is, this is more of a theoretical question. I believe an anonymous attendee is asking what IRR is. That's short for internal rate of return. You can do it in Excel, but the concept of it is you put all your cash flows in an investment in a model, and then it tells you how much return you got as a function of how much time it was out. So in the development, it would be negative cash flows as you're investing into building the building, and then positive cash flows when you refinance and through operational cash flow and then ultimately sale. So you put that all into a stream in an Excel model, and then it'll tell you what your internal rate of return of capital was. So that's what IRR means. Another question was, what does a non-tax client mean? I believe I used that term before. It just means someone who is a US citizen who pays taxes, like me or Dave Welk or any of our 2,600 clients. So a non-tax client would be a pension. They don't pay taxes, or an endowment, they don't pay taxes. Or if you're an individual that has a foundation that's sizable, that a foundation is a non-tax entity. So these would be examples of non-tax clients. We don't have those here. Our partners are all taxed, and we share the same goals, which is to generate the highest returns, but also minimize taxes so that you get the most post-tax return you can. Or in the case of real estate, you can defer taxes through depreciation, which is interesting. All right. I'm trying to find one for you that isn't a business question. Okay, Dave, this is anonymous. He says it's confusing that the land is appreciated so greatly. Why are the current owners willing to honor these prices if we've tied them up 6 or 12 months ago?
Great question. These are legal contracts that are enforceable. You have remedies to sue the seller if they do not perform through specific performance and other litigation measures. So it's not that they don't realize that the market is moving against them, it's they have a contractual obligation to sell at that price.
Yeah, that's exactly right. We have them under contract. They have to perform if we do. So, and believe me, some of them try to get out, but they can't. That's not something that we would allow them to do. A contract is a contract for a reason. All right, another anonymous question. This is a good one. So you said earlier that historically you've done 25% net returns on developments. We represented it as 33.7 gross returns. I equated to 25, that's correct. And then you say today you're seeing these large development margins, the largest in your career. Why are you projecting 11 to 13% returns? Well, we're not projecting 11 to 13. We're projecting 14 to 16 net. I'm not sure where that confusion is, but 14 to 16%. And then he or she adds, are you just trying to be conservative? Yeah, generally, I said we try to over deliver and under promise. So yeah, I believe we are being conservative, number one. But remember this, no matter what projected returns we tell you, they will be different than what we tell you. We don't know the future either. What I do know is we'll outperform other competitors in development. We always have, and we will here too. So I can tell you our target returns are 24 to 26%, 14 to 16. No one knows what the future holds. I do know that we have really discernible competitive advantages in sourcing, in investment management, and risk management. We know how to build and we know how to operate real estate, and we've done it really well for a long time. That I'm really confident of, but am I confident that it'll fall between 14 and 16? No. If I told you it was 23 to 25, would I be more or less confident? I wouldn't. We don't know what the world holds in 4 to 5 years, but we do know that we have a business that has high expected value. Okay, so we had a question about 1031. Okay, here's a good one for you, Dave. For the 6 pipeline deals, when will the construction costs be fixed? Do you think they'll fit within your underwriting, or has inflation increased pricing?
Varies by the deal, and I was trying to give a little bit of color on that, just in terms of when the land takedown occurred, and then when we would break ground. The groundbreaking, we will have a fixed price, if you will, with our GMP in place, with the caveat that in some line items, general contractors are taking zero risk at this point. No, for the most part, most general contractors are not giving you, they're not guaranteeing the price of lumber. All of these projects are wood frame construction. That is growing input cost and as a percentage of the overall project from where it was. But I would say that at groundbreaking, we're going to have as much of that risk on cost hedged through a GMP as we possibly can. We have other proactive measures on how, as I mentioned before, we monitor the lumber pricing market daily. We're in constant contact with our lumber suppliers on when that market goes up, when it goes down, and we're in a position to execute and take advantage of market movements. So for example, the most near-term projects that will have cost risk mitigated will be the 2 that I mentioned that are most near-term in terms of their construction starts. So Preserve and Star Ranch, Haven and Apache, and Haven and Cool Springs. Those are the 3 that are going to be the most protected for any near or medium-term increases. On the other projects that are further out from closing, Samford Road, which we didn't get to in Charlotte, will be the latest in the pipeline. That'll probably be an October closing. what we've done there is we've underwritten significant cost escalations in the market to occur in our underwriting, and that is what's presented to our deal committee for approval. So we typically inflate costs anywhere from 0.5% to 1% per month from when the deal is presented to when we believe we will lock in that GMP and we'll be breaking ground.
Thanks, Dave. I'm going to take us home. I still need to cover fees as well, so I'll answer a few questions and then we'll cover the fee side. Question about is this an OZ fund or not? No, it is not a QOZ fund. We have a QOZ fund too that's currently raising. I believe it's raised 150 million of its $300 million target. We launched that fund in October of last year. So the raise has been pretty brisk. Then the investor goes on, potential investor partner goes on to say, do you co-invest this market rate fund with your OZ funds? No, never. We don't do that. These are individual funds. We would never co-invest with another origin fund. Okay, I'm going to keep going. Can you share how much capital has been raised to date? Yeah, the growth fund we launched in mid-January. We don't, the first close is going to be March 31st. I will give you a range. The fund is a $250 million fund. I think we'll raise 30 to 50% of the money by the first close, which is in March. That segues into your next question, which is how long will we be raising? We'll be raising about a year or until we reach that goal, which is 250 million. The raise is going very well right now, so I can't estimate when it will be completed, but it's going at a pace that exceeds our expectations. Okay, so minimum investment, great question. I'll cover that on a slide in a moment, but it's 50,000. So that's that question. Had a question about swaptions. Do the swaptions cover you through construction, or is it through the entire hold? And the answer is through the entire hold. So we're buying long dated swaptions. So it's not just the construction period, but it's also covering you well after that, which we think is important. So these are longer dated swaptions is the answer. And with that, I apologize if we didn't get to any of your questions. We actually had, I think we had 21 questions, and then a few of you like to use the chat box, so you're cheating. Please put them in the Q&A. A lot in the chat. Let me think. I'm in the chat. Mike, how are you? He is asking about the option period. Okay, so during the option period, his question is, if you have requests for redemptions, how is capital returned? It's returned either through cash flow, through refinance, or sale if necessary. So in that order. And if we have a lot of investors that don't want the option of holding and accumulating long-term wealth that way in a tax-efficient fashion, we will conclude the fund, and it'll just be a development fund. But if we have lots of people that want to stay in, obviously it stays operating. So these are all things that you, the investment partners, will have plenty of input into with your own needs at that time. Okay, can we load the slide, please, on terms? So summary of terms, I covered the $5 million co-investment. That'll be Origin investing into this fund. It's consistent with the 65 million we've co-invested in our prior funds. The target fund size, we just said 200 to 250, that's the cap. Fundraising has been quite good. Minimum investment, 50,000, we covered that. In terms of our auditor, fund administrator, and legal counsel, these are all the same that we've had in past funds. So these are all people we've done business with prior, both on legal, fund admin, and audit. The initial fund closing March 31st, so that's coming up very quickly. What's important about March 31st is we are doing an appreciation incentive really for our existing clients. We have 2,600 existing clients. If an existing client wants to be in this fund, they can be at a discounted management fee up until March 31st, and then it goes away. So if you invest, I'm going all the way down to the term section, annual asset management fee. Commitments under 5 million or 1.5% annual. Above 5 million, it goes down to 1.25% annual. But for our existing investors, if you invest by March 31st, you get 1.25% as well, regardless of your size. It can be 50, 100, much, much less than 5. If you're an existing client, that's something we're doing for you, really to honor the partnership and show you that we appreciate being your partner. The final closing is 12 months from the initial closing. So our initial closing will be March 31st, 2022. So the final closing will either be March 31st, 2023, or when we reach our goal, in the event that we reach it faster than that. The capital call period is a period of 24 months after the final closing. I can tell you that based on our deal pipeline, and Dave has covered this as well, we anticipate, and this was a question we had, we anticipate calling lots of capital quickly. There's going to be a tremendous amount of your capital called in the first 6 to 12 months. And so expect that. If you're going to make a commitment, expect to have capital called. It's not going to take 2 or 3 years for that to happen. And then the development period is the 48 months following the final close date. Liquidity, we covered quite a bit. That's the optional period of redemptions. And if you have questions that you want answered in a deeper level, I know we're a little bit over. A couple things. We have 7 people in investment management. Investor relations. You can obviously talk to them, or you can email me directly and I will forward on. I'll either answer the question or I'll forward you to some of the professionals you need to speak to. My email is david@origininvestments.com. You can shoot me a note at any point. If you want to talk on the phone, we can schedule a 15-minute call as well. My assistant Jennifer can do that. These are all things that are available if you want a deeper look into that. The last thing you can do is go to our website. I believe it was just up, but origininvestments.com. All these things are accessible via the website. It's a tremendous resource, both for this fund, but just in general. If you want to learn more about real estate, how it's priced, how you manage risk, how you select managers, I can go on and on. Our library is, in my opinion, the best in the industry because we're committed to making you as educated as you can before you make really important decisions. This is an important decision and you should be well equipped to make it the right way. Dave Welk, thank you so much for joining me from Charlotte, by the way.
Sorry for the technical difficulties.
Yeah, we'll work out the Google Maps, but you did fine. And if anything, we need more time to have you go into detail at the deal level. For the investors on the phone that are partners now, thank you for your partnership. For the new potential investors, please spend the time necessary to make important decisions. We believe the more you learn, the more you'll decide that we're the place you want to do investments and be our partner. But regardless, use our website and use us as a resource. Thank you for your time. And what do you think, Dave? Is Iowa playing today?
Hawkeyes are actually hooping it up, I think, in 5 minutes.
Okay. Yeah, Dave's an Iowa alum. So I'll tell you what, I'll watch a little of that too. Have a great day, everyone.
Happy St. Patty's. See y'all.